I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the data and news you need ahead of the Wall Street Open. Coming up, it's risk off as investors eye jobs data and also those elevated treasury yields. Meanwhile, oil slipping and extending its losses. Mixed supply signals, OPEC plus, and also dollar strength behind that story. And UAW strike continues. GM and Ford furlough another 500 workers due to industrial action. We'll have more on that in just a moment. Good afternoon, I'm Angeline Ong, and welcome to this new edition of Beat the Street. Not long now before Wall Street starts trading, this is how equity markets are looking. At the moment, it is risk off, as I mentioned earlier. Let's give you an hourly chart also to give you a better bird's eye view of what's happening in the markets at the moment. A lot of this coming as we see oil prices extending its decline. Let's have a look at the Tech 100 as well. Similar picture there, looking quite somber as we count down to the open. And also here's a look at the US 500 on the IG platform. Also looking like risk off as investors, rightly so too, wait on the jobs report outcome from that OPEC plus meeting as well. Now, as I mentioned earlier, supporting sentiment, oil prices extended the declines early in the session after falling to a 3-week low in the previous session. Now, much of this was due to the strength in the dollar, rising bond yields, and also those mixed supply signals. Analysts at ANZ said that crude oil prices slid to around $90 a barrel as rising US yields and that stronger dollar dominated market sentiment. We're also looking out for what comes out of OPEC plus. Of course, if you've covered this market and those meetings long enough, it's not what they do, but really what they say and the horse trading that takes on in the corridors of that meeting that actually give us a real clue to the direction of oil prices in the months ahead. Earlier, I spoke to Bob Dudley, the former CEO of BP, and he too said it was a really tricky time to try and even place a level on oil prices due to so much uncertainty and so many factors out there, including China, the R-word recession that's creeping into conversation, but also tight supply is also a big factor. The jobs report, we're of course counting down to that, and perhaps it could also give a further indication of just how resilient the US jobs market has been, which has confounded many investors. We're watching out for comments from Atlanta Fed President Raphael Bostic when he speaks on inflation. Keep an eye on that because, of course, inflation and oil prices are interlinked and will be the key as to whether or not the Fed will raise interest rates again once this year or not. While Fed policymakers disagree on how high rates should actually go, there seems to be no discussion that monetary policy will need to stay restrictive for some time to bring inflation back down to the Fed's 2% target. We had Fed Governor Michelle Bowman saying that despite considerable progress, inflation continues to be too high. And then speaking at a separate event, we had Michael Barr also talking about the importance of whether or not an additional rate hike is needed this year or not, but rather how long we'll need to hold rates at a sufficiently restrictive level to achieve those goals. And he then added he expects that it will take some time. Cleveland Fed leader Loretta Mester also adding to all those comments, saying that the Fed's work is probably not done, suspecting that the need to raise the Fed funds rate once more this year and then hold it there for some time. UAW and those strikes affecting the US car industry still dominating many headlines as well. GM and Ford this time saying they'll furlough another 500 workers due to the UAW strike. Just getting the chart of General Motors up for you because General Motors is an all-session stock on the IG platform. As you can see there, it has been ticking lower the longer this strike action continues. Also showing you Ford. Ford has on an hourly chart come up slightly, as you can see there. However, if we look on a daily chart, you'll see a similar sort of trajectory that has come off where it was prior to that in mid-July. Now, what's also interesting is that the UAW workers seem to be continuing with the action with no deal on the table just yet. The daily cost of strikes is almost certain to rise weekly. That I can tell you is the agreement, the consensus out there. But what is also interesting is many brokerages, many houses are coming out with estimates as to how much these strikes are costing. And JP Morgan has come out and stuck a figure on it. And they are saying that perhaps Ford has lost $145 million during the quarter. And GM, they estimate, has lost $191 million in operating profit. Now, moving swiftly on, we've also got Boeing on our radar because Boeing has just come out with some numbers as well in terms of how many aircraft it is looking to push. And in terms of its production as well, it's pushing the production of its best-selling 737 narrow-body jet to a record of at least 57 per month by July 2025. Now, this is interesting, of course, because it reflects the rising orders and the company's recovery after the 737 MAX crisis, says two people close to the matter. Boeing has laid out its plans of its latest version of its master schedule of suppliers. And also interesting to note, both Boeing and Airbus, its European rival, have laid out ambitious plans to ramp up goals as air travel and aircraft sales rebound. To central banks, and just giving you a recap, as expected, Australia's central bank did hold interest rates steady for a fourth month. The RBA holding rates at 4.1% and said recent data was consistent with inflation returning to its 2 to 3% target over time, with output and employment still growing. But yet again, the RBA warned that further tightening might be needed to bring inflation to heel in a reasonable time frame. For more on this and other risk assets and the Aussie dollar against the US dollar, IG's Chris Beecham took a closer look.
Q4 is normally a good one for risk assets overall, but it certainly hasn't got off to a very good start. You've got equities under pressure once again, although some signs of strength in the Nasdaq, maybe some bargain hunting going on there. And if you're looking at risk, one of the best proxies is the Aussie dollar against the US dollar. That's dropped today to its lowest level since November of last year, as the hawkish comments from the Fed, more hawkish comments from the Fed we had yesterday about keeping rates unchanged, really prompted a round of fresh buying in the US dollar and has caused yields to move higher once again. So it's not a great start to Q4. We'll see whether that starts to change as the month goes on.
Of course, New Zealand's next on deck on the interest rate front. Now, before we go, let's have a last look at how the market is looking as we are now minutes away from the open. As I mentioned earlier, here's a look at Wall Street, or rather the Dow Industrials, and we are looking at a risk-off mood as prospects of an extended restrictive monetary policy push 10-year Treasury yields to a fresh 16-year high. Also in our radar, we are looking at OPEC Plus and what we hear out of that and what that means for oil prices. And that is it for this edition of Beat the Street, the show that follows the trading action, helping you position yourself ahead of the opening bell. For more trading insight, follow me on @IGCom and @Angeline Ong on Twitter. This is IGTV.